Geopolitics is definitely the number one risk for a lot of these companies.
Chinese companies are forced to really focus on to develop their own technology breakthroughs.
If you want to find the real enablers of AI in Asia for both China and for the US, all roads lead to Taiwan.
Hello and welcome to the new Investor's Guide to Asia podcast, where we explore the most intriguing investment stories from Fidelity International's portfolio managers and analysts working across the region. Keen listeners will no doubt notice that we're expanding our horizons to bring the best investment thinking from all corners of Fidelity's operations in Asia. China, of course, will remain a large part of our discussions, and we'll be getting regular updates from Fidelity's Asia economist Pei-Chin Liu, who will be talking about the latest macro dynamics in the country. She'll be joining us later. But we'll also be delving into a wide range of exciting sectors, asset classes, and countries across the region, whether that's tech in Taiwan, industrials in India, or hey, maybe even K-pop in Korea. We'll be looking far and wide across the broad tapestry that makes Asia such a compelling investment case. I'm Stuart Rumble, the head of investment directing at Fidelity within Asia Pacific, and I've worked in almost every asset class in my time at Fidelity, and I've lived in Asia for over 7 years. I'm delighted to be called up to the pod because my job is to talk to our investors about what is going on in markets in our portfolios, and I'm looking forward to bringing that perspective to our discussion.
And my name is Taosha Wang. I'm a portfolio manager at multi-asset team at Fidelity International. My job is to invest in the most compelling growth themes and trends. And the question I ask myself every day, what are the most relevant innovation today and how will they affect our future?
And that's a great place to start, obviously. Our episode today is all about innovation, and no doubt China will feature very heavily within that, particularly because of the latest exciting announcements around DeepSeek. And hey, that was me getting AI in within a minute of starting this podcast. We're delighted to be joined in the studio today by Tina Tian, who's a portfolio manager who's based in Hong Kong, has a particular focus in investing in innovation within China. Hi, Tina.
Hi, Stuart.
And we also have Jonathan Tseng, who sits in London and leads our global technology coverage at Fidelity. Welcome, Jonathan.
Hey guys.
Tina, let me start with you. How exciting is it to be investing in China innovation right now? I mean, the DeepSeek moment is more than just a technology breakthrough. It has had so many implications across capital markets.
Exactly. It's really exciting to be investing in innovations in today's world, especially after the DeepSeek's breakthrough. I guess if I take a step back, a key thesis of China innovation strategy is that China has a lot of structural advantages to deliver innovations, such as R&D, data, talent. But in the past few years, this has really been overshadowed by a domestic economic downturn and also geopolitical tensions overseas. Especially in the past 2 years, with very rapid AI development in the US, plus the chip export bans to China, there's a perception that China will be constrained technologically. However, the success of DeepSeek early this year has really helped dispel some of the beliefs and boosted the confidence, showing that necessity is the mother of innovations. Despite all the constraints, China can still develop very good models at competitive costs. So that's really encouraging.
DeepSeek really is a game changer, isn't it, in terms of just sentiment and also the innovative landscape in China. It is also shining a spotlight on some of the other emerging and established parts of Asia in terms of AI developments. Jonathan, where are you seeing progress in AI in other parts of Asia?
The thing I'd say is outside of mainland China, which is obviously the center of gravity for AI in the region, ultimately all roads lead to Taiwan. Taiwan is a leader in the world's chip-making industry. American companies rely on Taiwan, European companies rely on Taiwan, and Chinese companies rely on Taiwan. And you need to look beyond TSMC, obviously the foundry leader. There was an ecosystem of companies working on AI around TSMC. You have companies like Allchip, for example, which is designing cutting-edge chips for US hyperscalers, competing with NVIDIA. So I think if you want to find the real enablers of AI in Asia for both China and for the US, all roads lead to Taiwan.
I was scrolling through a social media account the other day, and I came across the excitement around Manus. A Chinese developer has created an AI agent which does sort of hundreds of tasks. I thought it would be quite a microcosm of what the economy could look like in the future. Obviously, it's a Chinese developer. What next for AI in China, Tina?
I think, first of all, we're going to see big progress in the AI ecosystem in China. Especially, I want to emphasize that we're going to see a lot of localization of both software and hardware. So, as we already discussed, DeepSeek, Manus, and other companies like Alibaba are developing their own large language models, and also hardware chips. Right, the local chip companies are working with these software companies to develop good local solutions to the AI problems. And with lower cost in large language model, in AI in general, we're going to see more adoption of AI. So, for example, to C, which is to customer, we're seeing a lot of applications such as DeepSeek, Tencent's Yuanbao app, and also ByteDance Doubao are seeing users really growing. And then from 2B perspective, which is to business, we're also seeing good adoption whereby companies are using AI tools to improve their productivity, to improve their digital marketing efficiency, etc.
I guess kind of touching on Manus' example of an AI agent, and the big picture point to make is that these are applications built on top of large language models. Large language models like GPT or DeepSeek, they are a foundation, but you need to build end-user applications on top of them, which is where Asia has a chance to innovate, because it's hard to build the model, but it's easier to build an application on top. ChatGPT is an application. Story video generation is an application. And so like Manus and agentic AI, which chains together lots of different models as an application. So this is an area where people from all kinds of countries and nations can innovate. And the other thing is, agents like Manus are massively compute intensive. They chain together tens or even hundreds of model calls to produce a single result. And what you need is the lowest possible cost compute, because there are so many model calls. Again, that plays to China's advantages, because we've seen DeepSeek pioneering the idea of dropping the cost of compute by 10 times, 20 times, 50 times, which is what you need to enable these applications.
Yeah, Jonathan, following this line of thought, how are global peers responding to the fact that such major breakthroughs are coming out of China?
I don't think it's a wake-up call for the West. And the way I think about it, the West needs to both compete and co-opt. And compete, as I said, Western companies are probably complacent in assuming they were a year, 18 months, 2 years ahead of China. When actually, if you look at the history of the last 10 years, China has innovated in so many ways. You look at mobile applications like WeChat, you look at mobile payments, China was ahead of the West. So in some ways, we should not be surprised to see China taking the smarts which built WeChat and applying it into AI models. So the West needs to compete against this and redouble their efforts and lean into their strengths. Because if you have export restrictions on chips, it's harder for China to get chips to compute. It's relatively easy for Western companies to get chips to compute. So they need to lean into their strengths, build out these clusters, take advantage of systems that can exploit those. So you need to compete. But the other thing you need to do is co-opt. And the thing about DeepSeek is it is open source. Western companies can take what it does and build on it, just as China has built on Western open source. So there's a real opportunity, and you see Western companies from Perplexity and many others immediately using DeepSeek to build their applications, to build their propositions. So they have to co-opt and compete. But I think one last thought is you also need to cooperate. You can't ignore China. And you see many countries in non-aligned nations which are really engaging with China in pursuit of technology. Particularly, I think about some of the European kind of more non-aligned companies. You see chip companies with a China for China strategy where they build Western-designed chips in Chinese fabs, paid for by Chinese money for Chinese consumption. And so I think the West, they need to, deal with this challenge in many different ways. Compete, co-opt, cooperate.
We get lots of technological terms when talking about technology. Maybe we can just take one step back, Tina, for a second. And when we talk about innovation, we often talk about leading edge and trailing edge. What does that actually mean?
So leading edge are those innovations that are truly globally leading and groundbreaking. So some of examples in China I can think of are, electric vehicle industry, mobile payment, like Johnny just mentioned, led by Weixin Pay and Alipay, and drones, for example. And then for trailing edge are, those innovations that are actually based off existing technologies, but we make incremental improvements and optimizations to make it better and more efficient. Examples include AI, robotics, and drug development.
We've talked a lot about examples that are having a real benefit and impact in China, but where are some of these Chinese companies leading globally, and what do they need to do to maintain their edge?
One example I can think of is really electric vehicle industry, where China leads the rest of the world. So in 2024, China actually made 60% of the world's electric vehicles, and 50% of all the passenger cars sold in China are EVs. And behind that is a comprehensive, very efficient supply chain, especially battery. So we continue to see a lot of breakthroughs in the battery technologies across all energy density levels and a combination of different chemistries. And the electrification also expands from auto to forklifts. In the future will be to ships and to bullet trains. So other than the electrification, we're also seeing the vehicle intelligence is really picking up. So the ADAS adoption in China is already very high, and we're stepping forward into the L3 era. Chinese government actually has a target of achieving 20% L3 penetration by 2030. So, and plus there's a lot of L4 level kind of autonomous driving developing in China as well. So that has a lot of implication to the ADAS and autonomous driving supply chain. So you asked about what the company should do to maintain that edge. I think if we kind of take a step back and look at some of the advantages that Chinese companies have. One is really continuous spending on R&D and talents. So there's a sufficient, abundant talent pool in China, which are relatively lower cost, but very, very hardworking. If you look at the R&D spending by private companies in China, it has been growing by 20% CAGR in the past decade. And then China has a huge domestic market, which is really important for adoption of a lot of the new technologies to have that scale to drive down the cost. And also the supply chain. China has a very comprehensive, efficient supply chain, and we've seen even during COVID that superior resilience of the supply chain. So I guess the Chinese companies have continued to invest in R&D in their supply chain, which will continue to support their lead in these innovations.
And you mentioned the government in your comments there. They play an important role, and we all watch what they do. There's been a couple of recent events that have been important. President Xi brought together, obviously, a lot of the private sector leaders, including Jack Ma making a comeback. And we've had the NPC recently. What were your key takeaways from those meetings?
Yes. So in the past few years, we actually saw some regulatory developments, especially for the tech sector. I guess, from now on, we can say that the regulatory framework has been established. So going forward, the regulation, the supervision will be more normalized. And the very important meeting you just mentioned between President Xi and some of the private sector business leaders really suggests that, the recognition from the government that the private sector is playing such an important role in both helping solve the challenges domestically in terms of employment, economic development, and also leading innovation structurally. As for the NPC recently, I think the overall tone is a continuation of the supportive and accommodative policy stance that we've seen since late September last year. But it's not a very aggressive kind of stimulus. It's more like putting a floor in the sand. But the key focus is really on domestic consumption and innovation, which are more structural for the country.
What do you think, Jonathan?
I think just to add to that, it's clearly not an either or. The government needs a private sector to drive innovation. The private sector needs a government. And when I think about it, obviously you have private sector smarts who build things like WeChat or DeepSeek. But to build the infrastructure, the semiconductors, the data centers, to build it, you need capital, and the government supplies that. Then you can even go beyond that and say, the government can give Chinese innovation an advantage versus the West. And you think about the area of regulation. You think about driverless cars, enabling the regulation within cities for these things to work. You think about AI and, availability of training data. And in some ways, Western companies are at a disadvantage to Chinese companies because the government can clear away a lot of the regulatory challenges at a stroke. And that is an advantage people underestimate, I think.
Absolutely. I think especially if we take the view that AI is still in the early stage of its development, then the government support in terms of the whole ecosystem infrastructure is extra important.
Jonathan, Tina, you've both obviously talked a little bit about EVs, which has got to be one of the most interesting areas and important areas for innovation within China. And some of these cars look fantastic as well. I managed to look at the SU7 the other day, and it was just beautiful. I caught up with Eric's, our Hong Kong-based analyst who covers this sector, to find out more about how China and their companies are shaping the auto industry. Hi, Eric.
Hi, Stuart.
So you've been covering the car manufacturers for about 3 years now, and clearly there's been some major changes. What's been the most notable thing for you?
I think the most notable thing is the speed at which the Chinese companies in the industry have innovated and reduced its cost over a short period of time. If we look at 2021, the best EV is actually the ones offered by Tesla. But today it's hard to say that anymore with Xiaomi SU7, with Huawei's vehicles. And if we look at a component that are usually used in autonomous driving, a LiDAR, to detect the distance between the object and the car, the cost of it has fallen from $1,000 3-4 years ago to only less than $200. So the cost reduction and innovation are really real.
And Eric, obviously I joined you visiting one of those LiDAR companies not that long ago in Shanghai, and you've been there more recently as well. It's a fantastically futuristic city, obviously. What's the takeaway from the latest trip that you took?
Yeah, I think the biggest key takeaway for me is how a lot of these companies are really taking a step at the autonomy problem and trying to bring that to reality in the next 3 to 5 years. And I'm really seeing a lot of new progress being made. Just to give you some examples, companies are trying to bring the latest technology to the latest generation fleet and get that into the market by mid or late 2025 and try to see if they can achieve economic break-even in application like robotaxi. So I think there's a lot of interesting potential to be realized within the next 3 to 5 years.
And some of these companies are really leading in terms of the latest developments in car manufacturing. Where do you think the real edge, or an example of a company that really is sort of at the forefront and leading globally?
In China, it happens to be the largest EV market thanks to the support of the government over a long period of time. And now, new technologies such as the EV battery technology as well as autonomous driving technology really have a good testing grounds for them to iterate their technology and improve. So I am seeing a lot of these, for example, EV battery companies already becoming the global leader, and a lot of these autonomous driving companies emerging to try to test the global leadership such as Waymo and Tesla.
And it's obviously the largest EV market in the world, as you mentioned, largest exporter of EVs in the world. And I'm sure that comes with some risks in the current environment. What are the things that we should look out for?
As you know, like every business industry is quite competitive in China. There are a lot of oversupply currently. So in order for a lot of these companies to earn excess profit and generate sufficient return to their investors, they're really looking to gain access to the global markets. So geopolitics is definitely the number one risk for a lot of these companies, trying to not only dominate the China EV markets, but be able to monetize their technology to benefit the rest of the world. So I think that's one thing that we have our mind focus on, to understand how they can, for what ways and business models and innovation they can benefit from the global market.
Eric, thank you very much for your insights.
I feel like every time Eric speaks, I'm hearing directly from the future. But one important thing that I really took away from that short interview was that the significant improvement in quality is happening at the same time as the rapid reduction in cost. I think it speaks to the fundamental of technology, which is about getting more things done for less. Jonathan, people have often talked about the physical manifestation of AI being the next stage of AI development. What do you think about that idea?
I think it is the next stage. And the way to think about it is that so far everything you do on your computer has gone through your screen. When you had your PC, it went through your screen. Then it came to your smartphone, it went through your screen. That's great. Screens are great, but screens are only only in your life a little bit of the day. If you can get the AI out into everything else, driving around, walking around, in the home, cleaning, this is the whole robotics thesis, then it means the benefits of digitalization, which so far we only consume via our screens, can be consumed and be spread out in everything we do. So far digitalization really affects kind of white collar roles or, things we can see, we can type in and out. It's much slower. You have to put things in and out of the screen. But if you can just see a robot, point to a robot, talk to a robot, drive a car, then suddenly many more parts of human activity, of the human experience, become addressable by AI.
And Jonathan, when you and I and our other investment professionals meet the investors that invest with us, they often ask about our research process and how we stay on top of all this science that's taking place. How do you translate, your research into investment ideas?
I think I'll say at Fidelity, we like to talk. We talk to companies, we talk to supply chain, we talk to industry, and above all, we talk to each other. We have analysts across the globe. I'm in constant communication, constant chat with them during the day, during the evening. I was on the West Coast in San Francisco. My colleagues from the Asia team were there. We were meeting companies. And the free flow of information from the companies to us, between the analysts to the portfolio managers, that's where the ideas come from. Because we see things and we put things together and we spot things before the market can spot them. So I think, in essence, is because we are always talking and always sharing information.
Tina, maybe you could tell us a little bit about your investment process. You were an analyst before, and now you're a portfolio manager. You've navigated through the complex and rapidly changing China innovation scene. Tell us a little bit about it.
Sure. So my investment philosophy is really, I believe that innovation drives better growth, stronger return, and ultimately stock return. And my observation is that the markets tend to be more focused on short term. We talked about the domestic economic downturn, we talked about geopolitical tensions, etc. But people sometimes forget there are structural advantages or strengths that an economy or a country has to continue to deliver secular innovation and growth. So I think that kind of secular structural opportunities are usually underappreciated. Throughout my analyst years and being a PM, I've observed that China has really climbed up the ladder of innovation from used to copy and a lot of the existing technologies to really lead the world, supported by the advantages that we just talked about.
And your philosophy there really speaks to the breadth of growth opportunities within innovation in China and the region. Jonathan, we've taken a look at a lot of the AI developments, but there's a lot more to it, clearly. What are the emerging technologies that are exciting you at the moment?
I think we kind of touched on the robotics side of thing, and the idea that you can take AI and put it into the real world, and taking people to put it into the real world is the next frontier. And this is not just robotics. You see what Meta is doing with kind of AR glasses, and what Apple is doing with Vision Pro. And it's simply opening up the space to be able to put technology in front of you, whether it's robotics or vision. And as I said, in the past, all of technology went through the screen. Now, only what you can see on the screen technology could operate on. Now, everything you can see, do, feel, or touch, technology can work on. So that's the first thing. And the second thing, the idea of, intelligence as a real enabler, in our everyday tasks is hugely exciting. And the way I think about it is, as an analyst, the most important resource I have is time. I'd like to, spend as much time as I possible thinking about investment ideas, thinking about winners and losers. But there are many other things, we need to do with our time. And you have, things like deep research agents, which can automate a lot of the kind of the bread and butter work and free me up to be even more productive. It sounds quite hypothetical, but as I said, if I can find 3 or 4 more hours a day, I can be 30 or 40% more productive, and produce 30 or 40% more ideas. So the idea that AI agents can do for white collar workers what it did for kind of factory line workers and just make us more productive and give us more tools, is hugely exciting. And kind of people say that technology might take away our jobs and might leave us with nothing to do, and it always comes back to the idea that you had cars replace horses and the blacksmiths found better things to do. In the old days, spreadsheets used to literally be, my first boss said spreadsheet used to literally be drawing lines on a paper and calculating numbers with a slide rule. And now we have Excel, and we can run scenarios and look at outcomes which would have taken days to compute in the past. So think about that leap on another scale. If we can truly have intelligent models and intelligent machines, acting as a colleague and a companion and a cooperator, that's what really makes me excited about what's going to be coming down the tracks in the next 5 years, in the next 2 or 3 years. It's coming. You got to get with it.
Okay, Tauscher, it's time to take a step back briefly from this conversation and catch up with our Asia economist, Pei-Chin Liu. Here's what she's looking at in China and the rest of the region.
So Chinese policymakers have met last week and this to set their main economic and policy targets for the year ahead. We didn't really see lots of elements of surprises in this meeting. They have maintained their GDP targets unchanged at 5%, largely signaling their appetite to maintain stability, lower their inflation target marginally to 2%, but coupled with more fiscal easing, moderately expansionary in terms of fiscal deficit targets to 4%, as well as about 3 trillion additional bond issuances. Taking that together, I think that's a moderately expansionary package that's perhaps enough to secure a stable growth momentum, but without considering the external headwinds that's about to come. I think for China, the main uncertainty or risks to watch out for is the external risks. We know that the Trump administration have initiated an American-first trade policy with investigations on China's trade practices, as well as China's progress of fulfilling U.S.-China Phase 1 deal. So now that's about to end or conclude initially in April, and that perhaps preludes some more tariff policy that's about to come. The U.S. has already imposed 20 percentage points additional tariff on Chinese imports. And I think if that is going to be added further, it's going to be a very big headwind to China's external demand. I think for the rest of Asia, we are really watching out for 3 main narratives. The first and foremost is definitely what the Fed is going to do, because that pertains Asia's ability to balance between stimulating domestic demand with gradual rate cuts and at the same time maintaining financial stability and capital flow stability. So that balancing act depends largely on the pace and outlook of the Fed's interest rate policies. Secondly, I think tariff is going to affect all the rest of the Asian economy as well. Trump has been flagging this possibility of imposing reciprocal tariffs, and that's going to have impact on many of the Asian economies who are export-oriented. And lastly, I think China's pace of recovery is also very critical for the region, given how deeply China is integrated into the regional and global manufacturing supply chain. So China's recovery will largely benefit Asia region as its demand picks up.
And we'll be joined by Pei-Chin for our next episode. She obviously referenced their tariffs. There's a lot going on geopolitically. Johnny, how do you see the recent tariff announcements impacting innovation in China and their ability for Chinese companies to compete globally, particularly in the high-tech industries?
I suspect it's more the volatility, uncertainty. The market hates volatility rather than the tariffs themselves. Tariffs, we live with them. We may argue about whether they're a good or a bad thing from whose point of view, but companies, will pass them on to consumers with whatever consequences that has. But I think, obviously the market seems to discount every headline as being the gospel truth. That creates volatility. We know it's not the case. We can sit back and think longer terms. What are the objectives of China? What are the objectives of the US administration? And try to hopefully take advantage of the volatility. I think when I think about China and China innovation, it's seen as a challenge. It's seen as a restriction. That they can't sell as many things overseas. They can't bring in as many chips as they want to because of export restrictions. But we should also think about tariffs as maybe a positive thing for China innovation. I mean, obviously it drives domestication of the semiconductor industry because, the US tried to clamp down on Chinese semiconductors in the last term. You see the massive redoubling of innovation in foundry, in semicap, in RF. And these companies, they got premium valuations because people recognized China was forced to build these companies up as national champions. I think another example is simply DeepSeek. The fundamental thing to realize is if you look at what DeepSeek did, all the innovations it did, they're about improving the efficiency of the models, about making do with less. They were forced to do this because of tariffs. DeepSeek succeeded and was so good because of restrictions, not in spite of them. And the more, the US squeezes down on China, the more China has to push back and innovate. That's the law. That's just how life works, and life finds a way.
It's really interesting when we meet companies, Tina. I always find the company management a lot more sanguine than I expect in the face of some of these challenges. I guess they've been dealing with them since 2018, so there's nothing new. But what do they need to do to sort of continue to thrive in what is clearly a difficult environment?
As you said, I think it's really nothing new, right? All these geopolitical tensions and tariff concerns happened a few years ago. So I think the Chinese companies have already done a lot of preparation. A few things they've been doing. The first thing is they have really diversified their markets. Their exposure to the emerging markets, has been increasing in the past few years. Two is they have really built their global footprint in terms of manufacturing. So we've been talking about China Plus One. So companies have been going out of China, building their manufacturing capacity outside of China, which can mitigate some of the risks. And third is really, as Johnny said, focus on developing their own technologies, right? As again, necessity is the mother of innovations. With all the constraints, actually, the Chinese companies are forced to really focus on to develop their own technology breakthroughs.
I think it's interesting because we always get sort of wrapped up as investors in sort of the negative headlines a lot of the time, and we maybe it's a bit too easy to overlook some of these amazing opportunities. Of course, one of the challenges for an investor is how much they pay for that opportunity and that future growth. And I think clearly it always sort of pays to sort of stay active and selective in terms of the companies that you're investing in.
I thought that, the conversation reiterated the fact that the path of innovation is never linear. The growth that we have seen in AI and other areas is truly exponential. And also the innovation process often has a spontaneous nature to it. You can never exactly predict when and where the next breakthrough is going to come from, but it's lurking in the corner waiting for you. So from an investment perspective, it speaks to the importance of looking beyond just a handful of, mega cap company. And of course, don't forget that China has a very important seat at the global innovation table.
Beautifully put. Thank you so much. And that brings us to the end of this episode. And we just have time to thank our guests, Tina Tian, Johnny Seng, and our other contributors, Eric Zer and Peijin Liu.
Thank you so much for listening. If you'd like to check out more about what's been covered today, check out your local Fidelity website or go to fidelityinternational.com.
And the producers today were Rory Fong, Noah Sin, and Holly Eastman, with production support from Tommy Su, Keith Chuen, and Dan Tam. The editor is Seb Morton-Clark.
Until next time, from all of us at Fidelity, goodbye.
Goodbye.